Is the clock ticking on Britain's AAA credit rating? The market seems to have given its verdict, UK borrowing costs today briefly rising above those of France. A downgrade may be only a matter of time. Well, the rise in yields today won't be welcome news to Chancellor George Osborne, and nor will the latest reading of Britain's service sector, which shrank in December at its fastest pace since April 2009. According to PMI data compiler Market, this points to a GDP contraction in the fourth quarter of 0.2%. So not the happiest new year then for Osborne, with the UK facing a possible ratings downgrade and a triple-dip recession. Out now to John Wraith, he's Global Fixed Income Strategist at Bank of America Merrill Lynch. Well then, John, UK yields above France's. Today, the three major ratings agencies have the UK on negative outlook. It's only a matter of time, isn't it?
It may well be, yeah. I mean, we've got a forecast of a 65% probability of a downgrade in the first quarter of this year. It certainly seems to be coming ever closer. We've got ever deteriorating forecasts for the peak level of debt to GDP. As you said, we're on negative outlook with all three of the major agencies, and it really wouldn't take much for at least one of them to pull the trigger. And
that would be, of course, politically toxic for Osborne. He's invested a lot of capital in holding the AAA and the ultra-low yields. How's he going to explain that one away?
Well, I think you're right. It's more of a political event if it does happen than a market one, as has been the case in other jurisdictions when we've seen downgrades. You know, there's already been comments about the AAA rating not being the be-all and end-all. I think the government, can see that it could well be something that's about to happen, and they're trying to downplay it already in advance. And to be fair, other than Germany, the UK is the only major AAA rated sovereign across all three agencies. So it's already happened to the US, it's happened to France, and there is a wider problem which doesn't just reflect the UK's fiscal and monetary policy stance. Well,
this week alone, 10-year gilt yields are up some 25 basis points. How high do you think they can go, given that growth is essentially non-existent, or do we see them come back down again?
Well, I think, in the very short term, they may be a bit overstretched. It's been the biggest sell-off we've had for 3.5 years or so in terms of the jump in yields in 10 years. But we do think they could go up further over the sort of coming weeks, maybe another 25 basis points or so. Beyond that, it's hard to see much more of an increase in yields as long as the front end stays anchored. In other words, as long as rate expectations stay very distant, because the curve becomes so steep that effectively any additional rise in long yields, it becomes extremely hard work.
OK, on to sterling. We're going to pull up a chart from Barclays technical analysts. They say if cable closes below 160.65 today, opens up a move down towards 160, and then possibly the low 158s. Are you as bearish on cable as they are?
No, I mean, I know that, technically it doesn't look great. That's a fair point. But I think, for us, although the US, I mean, part of the recent move obviously is about relief that the US managed to come to some agreement at the end of last year in terms of their fiscal problems. But they've only delayed it a few months, and by the end of March, we've got another 3 major hurdles to clear there. So the US is far from out of the woods with regard to its own fiscal problems. And in the UK, we're not seeing QE at the moment, therefore there is no sort of money printing going on, if you like, whereas there is in the US, and that's also something that should support sterling. So it has been a bit weak against the dollar, but we don't see it extending much further. OK, finally, John, just to finish up, there was a note from Citi today. They've put back their first rate hike in the UK to mid-2017, a full 8 years after they hit rock bottom. That's quite an aggressive call. It's not one that you share, is it? Not specifically, no. I mean, we certainly would say that a rate hike remains some way off. We don't have a specific date in mind, to be honest, because beyond the next sort of 12 to 18 months, it's just too difficult to pin anything down. But we think within the next couple of years, frankly, we hope that the UK has recovered sufficiently to allow the Bank of England to start easing rates away from the current level. But clearly, plenty of doubts remain, and the evidence of the past couple of years is certainly not encouraging. We haven't seen any growth at all to speak of in real terms since the coalition came in 2.5 years ago. OK, John, thank you very much. That was John Wraith at Bank of America Merrill Lynch. Well, the dollar continuing its positive start to the year after the Fed hinted last night that its QE programme may end sometime this year. That would be much earlier than expected.
The euro testing support today at 130, and according to Barclays technical analyst Phil Roberts, a break below 130 would send out a strong bearish signal, opening up a move down to 128.75, then down to 126.60. And finally, keeping in the vein of what's been a fairly gloomy UK news day today, shares in Marks & Spencer down more than 3% after Nomura cut its 2012-13 profit outlook. Nomura trimmed its pre-tax profit forecast for Britain's biggest clothing retailer to £666 million. That was down from £694 million. M&S gives its third quarter trading update next Thursday. That's all from us for now, but join us every day at this time to look at what's moving in markets and why. I'm Jamie McGeever. This is Reuters.